And we're officially live. Good morning and welcome to Money Matters, broadcasting live only on onedealaway.com/live. My name is Nev, and we broadcast every morning at 7 a.m. out of, well, Providence, Rhode Island right now. So that's where we are. That's what's going on. Yesterday we had a wonderful, absolutely packed episode talking about real estate. So packed that we actually ran out of time. And so today, even though we typically wouldn't do 2 days in a row of real estate, there was just so much information, so much news that I felt compelled that we have got to finish all of this stuff and talk about it. And of course, more news shows up. So things have been very, very, very filled with all kinds of stuff. It's really funny. Some days you go out and there's like not much happening at all. And then some days and weeks you show up and it's like news after news after news after news. You're like, I can't keep up. So that's kind of where we are right now. There's just so much going on, so much happening. And I think this is going to be one of the most interesting years we have all ever lived through. And I can pretty much guarantee that none of us around the world are ever going to forget 2020. Some of us might love it, some of us might hate it, but none of us are going to forget it. So today we're going to continue with our real estate update market. So we have additional information that is coming in from the National Association of Housing, basically of housing contractors. So this is an important piece because when we're dealing with contractors, that means we're dealing with like where is the supply? How quickly is this going to come in? We're going to be talking about how quickly are the markets recovering. What are some of the hot things that are happening in the real estate world that you can start thinking about potentially if you're looking to go out and do something within the industry? We're going to be discussing all kinds of things, including what's going on with the jumbo mortgages and some of the opinions about that, where the recoveries are the hottest and the coldest. We're going to be talking about what's going on with the whole eviction piece, what's happening with the stimulus plan, where's the unemployment, and some important, very important news for Texas. Yes, yes, yes. We're going to be talking about Texas a little bit. So, as you can see, full show, all kinds of things to talk about, and let's do this. And good morning, good morning, good morning. So here we go. It is Friday. So happy Friday to everybody, July 24th. Hopefully you're excited for Friday, but maybe not too excited. I know for me, I get very excited about weekends because I get to spend even more time learning and working. Yes, I might be sick. I understand. But when you love what you do, it doesn't feel like work. I promise you that much. So and when nobody's expecting you to do something or putting like ultimatums that you got to do it, it becomes so much more fun and powerful. And so for me, I don't see work as work. I see it as play. So I get to play this weekend. Do you? All right. So this is where we ended yesterday's episode, right? We were talking about the fact that there was a individual who had listed a house, received more than $160,000 above the asking price, and apparently it sold in like a week. And then the fact that there are many renters that are being squeezed. Now, before we go on and continue with what's going on in the real estate, I do want to make sure that we cover a couple of things very briefly right now. U.S. initial claims for unemployment insurance is back on up. So as you can see, this graph is actually quite lovely because we've seen this like giant off the chain jump in unemployment claims. It has kind of come down. It started to sort of go down flattish, and then we've seen a bit of a jump and an increase. And so this is one of those things that I think it's important to realize and notice that there's a bit of a change when it comes to where we are right now with the economy. And of course, we have been seeing and kind of expecting some of that stuff. I know everybody was really, really bullish once we hit into the July and everything was reopening and everything was great and lovely. And then we realized that, wait a minute, we're starting to have, I think they call them the hot spots. hotspot used to be a place where you would go club, right, and meet people. That was the hotspot. You would go hang out. Now, hotspot is a place you don't want to go to. So there goes that. Times are definitely changing. And so we are seeing that there's increase definitely happening in many, many locations and states. And so people are starting to shut down. People are starting to talk about shutting things down yet again all over the place. So there's all kinds of changes happening. We're also, aside from the shutdowns happening, we're also seeing that many of the employers, and we talked about it yesterday, many of the employers are actually, they hired whom they needed to hire and they have stopped. Some of them are still going back and re-looking, rethinking, recutting. So as you can see, this is not one and done deal. This is definitely an evolving piece, and it's going to make remainder of the summer, fall, and likely winter of 2020 and into 2021 very, very interesting. So those are the things that you can definitely expect to see. Now, I did promise that we're going to talk about what's going on in Texas, and there's an important piece of information and news that is coming for Texas, Austin, Texas, to be correct. And if you're watching this live, make sure you put into the chat of what do you think we are talking about here when it comes to Texas. So let me know what you think is going to be happening with Austin, Texas. And if you're watching this on YouTube, do the same thing in the comment section. It doesn't cost you anything, and who knows, it might be fun. So, and by the way, if you're watching this live, welcome, welcome, welcome. Super excited. We're going to go into Q&A at the end of the show, as always. And if you are watching this on YouTube, do me a favor, hit the subscribe button and the bell button so you get notified every single time the show goes live, which is every single day. And hit that like button so that more people get to learn about all this stuff. Let's help more people together. So, did you figure it out? Do you know what we're talking about? If you have guessed that Tesla is the big news, you are absolutely right. Tesla is picking a Austin area for its $1 billion gigafactory. This is very important. And you might be thinking, why is this important? This is Tesla. It has nothing to do with me. It has a lot to do with you because they're opening a factory, meaning manufacturing, meaning labor, meaning people, meaning employment, meaning homes, meaning real estate. Great deal. So congratulations to everybody who owns property in Texas, in Austin, Texas, and you have a likely hit a bit of a jackpot right now. So this is an exciting piece, and they're definitely going to be hiring. I mean, they will hire 5,000 people with wages starting at $3,500. So what you want to focus, if you are in Texas or thinking about going in Texas and you want to be close to where the gigafactory is going to be, you definitely want to focus and think about affordable housing. They're not going to go into luxury because at $35,000, they can't afford that. So you want to think affordable housing and how. Now, of course, I don't know all the rules, regulations, and kind of how things work out within Austin, Texas. But if you're there, if you're considering doing something there, you definitely want to read about it and learn more about how these things work. Now, yesterday we also talked about a very cool way that you can participate in real estate market right now and assist with the supply. I know that many of my students watching this, whether right now or right now, whenever it is right now for you, uh, are going to go back and say, I remember studying, I remember going through courses, I remember Nev talking about it. I know exactly what to do in the state of Texas to benefit from his teachings. But if you're not a student and you have no clue of what to do, you want what I like to call monster deeds. That's right. If you don't know what the monster deed is, you definitely, absolutely, 100% need to go to onedealaway.com and look for, you definitely want to look for Real Estate on the Cheap Challenge. That is where you can actually obtain the monster deeds information and education and learn how you can play within Texas area to be able to benefit from this new development that is coming. And so you definitely also want to keep up with what's going on with Tesla's factory and kind of how things are going, and when they're going to start, because you definitely want to be ready. Of course, if you are unemployed and looking for employment, and you are within the manufacturing sector, right? You are skilled labor. Perhaps moving to Austin, Texas might not be the worst idea on the planet, because if they're going to be hiring, you want to be around when they do that, right? So you definitely want to get ready to be able to do that stuff. So this is very, very exciting news for me personally, reading this stuff. And again, congrats if you are in Austin, Texas, and you're going to be making potentially quite a bit of money. So cheers to you. Mm. Ah, okay. Now, are you ready to continue talking about real estate updates in the market and what's going on, how to think about stuff? So, we've already given you one clue, and that alone deserves a like button. So, smash it right now if you're watching this on YouTube. All right. So, thousands in Silicon Valley in danger of eviction, and as end of California moratorium nears. And I would argue one brief thing, and that is that it's not just the fact that it's in Texas. I would argue that this is actually everywhere, not just in Texas, but that this is absolutely everywhere of where you can see that this is going to be happening. But this particular article is about California, so let's take a look into it. More than 43,000 households in the heart of Silicon Valley face eviction in the next few months. The estimate is that 43,490 renter households in Santa Clara County are at risk of eviction, which is about 16 times the typical number of evictions in a full year for the county. Now, this is very important for you to understand and prepare for, because this is what we are talking about, Silicon Valley in this particular case, right? We're talking about the California, one county in California, right? One area in California that is going to proliferate everywhere. We're going to see that everywhere. So you also want to be careful when you're going into real estate. And this is the reason why I keep saying right now is the seller's market. You want to sell. If you're looking to sell, it is time to sell, not a time to buy. Definitely not if you're an investor. If you need a home, I get it. I understand. You got to do what you got to do. Everybody has to have a roof over their head. But if you're just going to invest, not the time right now if you do it the traditional way, meaning you find on the market. If you go through the value property investment strategy that we talked about yesterday and that I hinted on today with the monster deeds, then it's a good time to go and do it, because you're so buying so low that it really doesn't matter what happens. Where you want to pay attention is what's going on with the real estate and the rental market. But here is the thing. We talked yesterday about kind of buying that and flipping it or refinancing and that kind of stuff. So we talked about a few of those strategies. Let's think about it when it comes to the rental strategy. So if you know anything about rentals and kind of how things are to work, when you buy and when you do the math, remember I said if the math works, do it. If the math doesn't, it doesn't matter. You got to walk away because it doesn't make financial sense. So it's not about emotions, right? We reserve emotions for humans that can be emotional back towards us, right? We love those that can love us back. You don't love things that have no feelings whatsoever. So, okay. So what you want to do is you want to use your head when you're investing, and what the best way to kind of quickly evaluate the properties is using the 1% rule. The 1% rule basically says I will buy a property at X amount of dollars if it can give me 1% or more in monthly rent, right? Now, you might have heard people talk about different things. They were like, it's fine if it's 0.5%. And people are saying, oh, as long as it pays something, it's fine. But, for me, I like to be very conservative with my investing. I like to be very conservative with my money. I look for bets that have a drastic sort of the risk reward ratio. I want the risk to be super low and the reward to be super high, right? A lot of times people go in for super high risk, but the reward is stupid low. It doesn't make sense to me, right? That's a casino. That's a casino right there. Yeah, sure, you can win, but your chances of winning are super minusculely small and your risk to lose is really, really big. I I don't do it. I don't do it. Why do it? There's no point to it whatsoever. But if there's, of course, there's risk with everything, right? So, but if the risk is super, super low and my rewards could be very high, then to me, that makes a lot of sense of why I would go in and invest. So while you could potentially be okay with 0.5%, I don't recommend it. Not that I'm recommending anything because none of this stuff is financial advice, right? Everything over here is just the way I process things, the way I think about things. And I just share it here to help you with education, to raise awareness about stuff for you to start thinking about, considering, and investigating further whether it is something that makes sense for you or not. If you need financial advice, you got to find somebody who's certified to give you that. That is not this guy, right? It's definitely not me. So you cannot, and do not take my saying here of anything as a financial advice, right? You got to think for yourself. You got to make your own decisions when it comes to everything and anything financial, or have trusted advisors that have treated you well over the period of time. And if you don't have any, then you definitely want to do a lot of due diligence before you adopt them into your sort of, inner circle of money. So my way of investing, my way that I teach my students, that I advise my clients, that I advise my family and closest friends, 1% rule. If it's above 1%, it's an amazing deal. 1% is the bare minimum. So if I can make $1,000 a month, $100,000 home makes sense. If I buy $100,000 home, but I can only get, $200 a month, that's a lose situation. I'm not interested in that. To me, investing in assets is you got to make money the moment that you buy. It's not something that you wait to sell. It's not something that you wait to go up in price. It's not something that you hope and pray that they reduce taxes and, it appreciates over time and that eventually in 5 years, it can rise and stuff. And I know that that's the game that many people play, but it is not the game that I like to participate in. If it doesn't pay, Nev doesn't play. Period. End the conversation. That's it. It's very simple, very rigid, and it simplifies my life a great deal. So while we're talking here about Silicon Valley, this is something you have got to think through for every single area that we're going to see something like 16 times the typical number of evictions. And that is going to start happening as soon as this summer and potentially fall. And as you may know, Congress has been meeting about the second stimulus package, and they are actually coming fairly close. Originally, they thought they were going to be able to release something yesterday, but they didn't. I have hard time seeing it that anything is going to be released today, so they are looking at next week. What does that mean? That means that my prediction was absolutely 100% accurate. And if you don't believe me, go back in a few episodes and watch what I have been saying since beginning of July, since end of June actually. So for over a month, I've been talking about it that they will not be able to strike the deal before unemployment claims expire. And so while they're still talking about it and they're still part of the conversation, it is a bit too late for about, I don't know, 35 million people. So 35 million people are going to be in a world of hurt come Monday. And why Monday? Well, because their unemployment benefits end this weekend. So, like tomorrow is the last check that 99%, and then of course I think New York is on Sunday. So by Monday, 100% of all unemployed people, 100% of 35 million, because it was about, 33.2 million, and now we add 1.5 million, so roughly about 35 million people that are unemployed, plus who knows who is not counted, so that could be even higher than that. But let's say that it is 35 million, right? They will not receive the check that they absolutely need the following week because, again, I don't know. I could be wrong, but they haven't met the deadline right now. So even if they might, the stress level for those that understand what this means is mounting high. And now they're talking about it's not going to be 600. They were talking about, 400, 450. Now they're talking about 200. Muchi has been talking about potentially meeting only up to 70% of their income pre being let go of. Well, guess what? People struggled to live off of 100% of income. Now you cut it down to 70%. World of hurt is coming, and it's coming fast speed towards us, right? And we're sitting on the track. And so I'm saying and asking you, step off the track. Step off the track because the train is coming. Yes, we're still going to get, all of us are going to get hurt, me included, right? Because this is global. This is, affecting everybody around the world, regardless of your skin color, your gender identity, sexual orientation, creeds, and nationality, language you speak, abilities, everything and anything that makes us uniquely, amazingly, beautifully different and cool, above all, it doesn't matter. All of us are going to be impacted pretty much the same way. Okay, so it doesn't discriminate. Now, with all of that stuff being said, right? How well is real estate market recovering? Let's take a look into this particular article, and I thought this was really cool because it's talking about 18 out of the 50 largest U.S. markets have reached or even surpassed January levels of market activity. It's a seller's market. I agree, and its eager house hunters, equipped with increased buying power driven by the low interest rates, are producing quick sales and higher prices. But now, let's take a look. 15 largest metropolitan areas that have shown the greatest and slowest recovery as of July 11th. And here is the data, right? And hopefully you can see that. Let me make sure that you can see it. And as you can see right here on the left-hand side, you will see most recovered markets. So we're looking at, Seattle, Boston, Denver, Philly, New York, LA, Las Vegas, San Francisco, San Diego, and Washington, Washington, D.C., meaning, are the ones that have actually seen the highest recovery. Seattle clearly leading the pack, and Boston being very, very close behind. Least recovered markets: Milwaukee, Oklahoma City, Louisville, Kentucky, Birmingham, Alabama, Minneapolis, Columbus, Ohio, Chicago, Atlanta, Providence, Rhode Island, and Richmond, Virginia. And yes, you're right. I am right here, number 9, right? Um, but that is okay because that means it's a little bit less competition kind of happening around here. And so you can actually buy a little bit more. And, if you know how to negotiate, you can get all kinds of things these days. You just got to be a little bit smarter than the average bear and be willing to walk away. One of the things I teach my students all the time, so I'm going to teach you here for free as well: be willing to walk away. It is not worth it. Do not get your emotions in it. I walk in, if I see it, yeah, I crunch numbers, I get excited. Heck yeah, I get excited if I can make some money. And I get something that is absolutely amazing that I can actually help more people. Oh, yeah, I'm right in there for it, right? But I walk in, and if I don't get what I want and we're not going, getting places, I walk away. I walk away. I drive hard bargains, and I'm not shy about it. Now, does that mean that I don't negotiate and like sort of willing to kind of give something? No, that's not what that means, right? It's not like stubbornly like it's my way or the highway. So you have to find this like fine balance of how you do that stuff. But I'm willing to walk away. I don't succumb and say, yeah, sure, whatever, will go your way. No, 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 no. And I have actually been known to basically shoot the realtor out of the negotiation and take over because I didn't think that they were doing a good job. So that tells you all you need to know about me. I can be a very, very, very challenging person at times, but I acknowledge that, and so I know that, and I work with it. Okay, so we've talked about quite a bit of stuff. Right now, we still have quite a bit of things to discuss and cover. One of those things is I want to talk about adjustable rate mortgage activity. We've talked about adjustable rates yesterday and the fact that the 30-year is still lower than the adjustable rate. But the interesting piece is that the rates are increasing, meaning the activity with adjustable rate mortgages is increasing. So we have an article right here that is talking about that the Mortgage Bankers Association latest weekly application shows an uptick in applications for the week ending July 17th, 2020. The market composite index increased by 4.1% from the previous week. Now, refinance activity showed continued fervor, whatever. I don't know why people use these words that nobody can freaking say. Okay, maybe not that nobody can say, but I have a hard time saying it. So I know what it means. I fervor, whatever. I'm not doing it. Refining activities show continued F word, increasing by 5.3%. Purchasing activity increased by moderately by 1.8%. MBA's 30-year fixed rate mortgage inched up by 1 basis point, which we talked about. It marks the first time in over 3 months that the rate increased, albeit by negligible amount. Purchasing and refinancing shows strong year-over-year increase of 19% and 122%. So purchasing up 19% year over year. That's huge. And refinancing 122%. And of course, people were refinancing because if you had a mortgage that was like 5%, but you can get something at 2.9 or 3%, why wouldn't you? Why wouldn't you? You're saving a bundle. Upswing of 4% in the latest week in the activity of adjustable rate mortgages. Changes in the activity of ARMs is the lesser followed indicator of economic uncertainty compared to the Treasury's 30-year fixed rate mortgage rate. The dynamic between fixed rate mortgage and adjustable rate mortgage drastically changed compared to most of 2019. Fixed rate mortgages have maintained lower levels of activity than ARMs, but by the start of the second quarter of 2020, the former took the lead. And right here, we can actually see the chart. So you will see that the fixed rate is this blue line, right? And you will see that the adjustable rate is this red line. And of course, adjustable rate had much higher activity. And then even in March and stuff. But then in April, you will see how 30-year actually took over the ARMs. And ARMs continue to make a smaller share of the mortgage market, and their share in the last week was 3% by dollar volume. 3% and by dollar volume was 7.5%. And it makes sense if you think about it, right? A, it's it's a fixed rate, right? So it makes sense. B, it's less than actually adjustable rate. And so it kind of makes sense of why people would do that. So to me, it makes perfect sense of why this is happening, but it is very, very interesting. Okay. Now, the next thing that I want to talk about is the existing home sales. And we know that they are they're posting a record rebound in June. We've talked about it, but I think it's important to get it from a little bit different perspective of kind of what are we talking about here. Existing home sales, as reported by the National Association of Realtors, rebounded sharply in June, showing a strong sign of market turnaround after 3 months of decline. Existing home sales, including single-family homes, townhomes, condominiums, and co-ops, jumped 20.7%, so almost 21%, the largest monthly gain since 1968. And on a year-over-year basis, sales were up 11.3%, but lower than a year ago. So they are still on a year-to-year basis up 11.3%. First-time buyer share increased 35% in June for 34% last month. June inventory level rose to 1.57 million units to 1.55 million units in May. So we've increased slightly in inventory in June. And as you can see, the first time buyers is actually up. So that's an interesting piece to kind of understand and see. June unsold inventory represents a 4-month supply, down from 4.8-month supply in May and 4.3 a year ago. What does that actually mean? Well, that means, so typically we were talking about this, I want to say last week. So go ahead and watch last week's video. You will find it on YouTube, Money Matters channel. And under, if you go to Money Matters or go under real estate, you'll be able to find it. So roughly about a week ago, you can do the math from what does that mean? Because today is July 24th. So just, -7. What does this actually mean? So what it means is that the supply is actually getting even tighter. You want to have about 5 to 6 months supply, right? And now we're really, really low supply. So when I say it's a seller's market, I mean it's a seller's market on crack. Can you say that? I don't know. Hopefully I can. If I can't, let me know so that I don't say it again. But it is one of those things that it makes sense for you to understand. Let's take a look at the chart. So here's a chart of existing home sales. And you will see that the condo and co-ops is this green line. Single family is the red line. And of course, total is the blue line. Gray is the recessions, recorded recessions. So you can see that, we're not necessarily where we were in the insanity of the 2005, 2006, but we have come up. Of course, we're seeing the dip and, we're seeing the kind of rise up. So that's kind of where we are. And the number of, I don't know what I was going to say with the number. I have no clue. I got nothing because I was enamored looking at the chart. I can't help myself. Sorry about that. Home stayed in the markets for an average of just 24 days in June, which is down from 26 days last month and 27 days a year ago. In June, 62% of homes sold were on the market for less than a month. So it's selling and it's selling fast and it's selling at a higher price. That is a key component of sellers' bubblicious market. In the June all cash sales share was 16% of transactions, down from 17% last month and about equal to last year. Home prices remain strong. The June median sale price of all existing homes was $295,300, up 3.5% from a year ago. And all four regions saw month-over-month gains in existing home sales in June, ranging from 4.3 in Northeast, which is the lowest, to 31.9% in the West, which is the highest. So no, I don't know. Existing home sales by region. So I don't know. I mean, yeah, I guess we're looking at the percentage because I'm like, West is kind of touted as highest, but you can see South is like on top of the game. So I don't know. I don't understand. I'm a little bit confused right now. I won't lie. So if you know what the heck is going on, please let me know in the chat or the comments in the YouTube channel. And again, if you're YouTube, it's time to smash the like button if you haven't done it already. So as you can see kind of where we were and what's going on, you can see something very interesting. So the Northeast, right, is seeing the smallest sort of month-over-month gains, right? But you will also see that we had kind of like this least steep dip. Like it dipped for sure, but it's not as steep as South is straight down, West is straight down. Midwest is closer to Northeast or not. Like if you really pay attention to it, and of course, South has kind of right. I mean, they're like what 50% back up to where it was the lowest when we hit it. West is what a third. Northeast, barely moved. It barely moved, and then Midwest has moved some. So very interesting to kind of see. This is one of those pieces that I keep saying it's all very cyclical and localized. And to me, it kind of makes sense that Northeast is sort of not doing as big of a sort of recovery weirdo dip thing and stuff, because what makes up a vast majority of Northeast? Let's think about it. New York City, Boston, Philly, DC, right? I mean, all of those kind of qualify as the Northeast, and of course we have smaller towns and that kind of stuff. But a lot of people live in those areas, in those cities, and we've seen that people are leaving the large cities. So it kind of makes sense of why that is happening right now, right? If you really think about it. Sales still remain below the pandemic level. NAR expects the market to continue to recover in the upcoming months as long as mortgage rates remain low and job gains continue. Tight inventory keeps pushing up home prices, which could be a bottleneck for future home sales. More listings and home constructions are needed to meet the rising demand. There is a slight problem with the whole home construction piece, and the problem is that they have stopped the construction, so they're running lag. And so, even though we struggle with the construction to begin with, now we're running at about 3 to 4 month lag in that area. And another piece to also remember is that when they were building, many people that are building that has been built have been a sort of like a higher priced properties and homes, and the reason for that is because financially it didn't make sense to build affordable homes. So I think we're going to see an even bigger rise or shrinkage, depending how you look at it from what perspective, of the affordable homes, and so that is going to be an interesting piece, which I have just realized that I have forgotten to give you the strategy earlier in the video, in the feed, right? So we talked about the whole percentage, and I was talking about the fact that we need more affordable pieces. So while you could go out and buy something on the market as is, right? You can go in and buy a house that is worth, say, $300,000. You buy it for, I don't know, $20,000. You renovate it and put another 50 into it, so $70,000 in it. If we follow the 1% rule, and if you were to buy something at 300,000, like value, like that would be probably a very nice house. Potentially it could be a multi-unit property, right, which is even nicer because that means multiple income streams coming your way. But then you can go in, if you go in with the 1%, or even if we go with the 2%, something of 300,000, if purchased property and in a correct market, would be able to fetch about $3,000 worth of rent. But now imagine that, that might be unaffordable. But if that property ends up being like a duplex or a triplex or maybe even a fourplex, then you can go in and rent it at about, five, six, $700 a month, which falls into the affordable rental category, right? It becomes very affordable, but for you, your returns are ridiculously high. And of course, you can calculate that, and all of the returns that you're calculating likely don't include the tax benefits that you get, which makes your returns even higher. So that was a strategy that I forgot to share. My apologies for that, but I'm glad that I remembered, and that we were able to come back to it. Now, talking about sort of the building and the remodeling and all of those different components, there's an interesting piece that I wanted to share here with you. One of that is that remodeling market is showing some optimism, and I'm going to share with you exactly what people are remodeling and how they're doing it to give you an idea so that you can participate. So here we go. And of course, to be able to sell things to people that want to buy. Remodeling market shows optimism, and there is an index. Of course, there's an index. It's a National Association of Home Builders, and they have an index called RMI, posted a reading of 73. So it's a 0 to 100, which indicates more remodelers view conditions as good. Each question is measured on a scale of 0 to 100, and an index above 50 indicates higher share view conditions as good rather than poor. And the average three components is the current market for large remodeling, moderately sized project, and small projects. And then they also take the future indicator, which basically takes what you have currently coming your way, meaning like leads coming in that you're converting, plus the backlog, like folks that you have already booked. And current conditions is average is 77%, which I would argue that that's really good. And future indicators is averaging at 70, which is very interesting and not necessarily all that bad. Compare market conditions to 3 months earlier. They were asking for that, and they're saying it's 66%. So still not as hot as they would like it, but it does indicate that they have improved rather than deteriorated, which is always a nice piece. It is also important to note that the remodelers face ongoing supply side challenges, such as rising material prices and the lack of skilled labor. And boy, can I tell you, there is a lack of skilled labor for multiple reasons. One of the reasons there's always, well, not always, but in the recent years, there has been a lack of skilled labor to begin with. Plumbers, carpenters, electricians. I mean, good luck getting them. My gosh, good luck getting them. It's very, very hard, and they're very, very, very expensive. So there you go, an alternative for what you might want to have in your career. But now that there's this unemployment benefit and all of that stuff, they're making more money sitting at home not doing anything, and it doesn't make sense for them to get on the job because they lose the unemployment, so they just don't. So now it's making it even tougher to actually get them to get the jobs done. And then the pricing materials, yes, they have actually gone up in prices. And there have been times, I won't lie, when we go in to get the building materials and do stuff for renovations and that kind of stuff, it's not even in the store. Like you can't even buy it, and it's a long wait. So it's a very interesting piece to kind of understand. So it's not, so it's a little bit on both ends of things that it's making it a bit more challenging to get some projects done. But the good news is people are remodeling and there's sort of like an uptick, but the future is a little bit less certain than what's happening right now, which again makes perfect sense to me and probably to you if you think about it. Now, what are they doing? What are they creating? And they're creating a thing called ADUs. Do you know what an ADU is? If you do, put it down in the chat, put it down in the comment section because I'm excited to read to see what your version of ADU is. But I'm going to explain it in just a second. Three, two, boom. Here we go. ADUs. So there's a new study that is revealing growing interest in ADUs. What the heck are ADUs? Well, those are accessory dwelling units, also known as in-law suites, basement units, granny flats, guest houses, you name it, it's there. It's that sort of additional apartment above the garage, next door, some sort of something that you got very creative to create either extra income in your property or to provide for your, kids with a family to move in or just a kid or for your parents to move in or, whatever, right? So that's kind of what that is. And it's a very big trend that has been on the rise. Now, they provide opportunity to expand affordable housing options on existing property. Census and most government housing surveys do not identify them. That is important to understand. However, Freddie Mac did a study and identified 1.4 million properties with ADUs in United States. They analyzed more than 600 million MLS transactions and identified listings mentioning ADUs for the first time to estimate monthly additions to the national ADU inventory. Nearly 70,000 properties with ADUs were sold in 2019 compared to only 8,000 in 2000. What does that tell us? Well, that tells us people are very interested in creating this passive income stream opportunity or creating an opportunity for their family, extended family, or maybe a nuclear family to live together, to cohabitate, right? So it's an interesting piece to understand. Approximately 1 in 5 remodelers noted they had completed at least one ADU development project in the prior 12 months. Remember, told you, I'm going to promise that I'm going to tell you exactly what the remodeling is doing. And 1 in 5, That is a huge jump. That is what, 20%? That is a huge jump. So you can actually see the number of ADUs listed on MLS for the first time across the United States, 97 2019, and you can see the ADUs and kind of what's going on. And you can see it's a very clear sort of rise on up. Right, and of what's been happening. So the South and West are the fastest growing regions for ADUs, with top markets including Portland, Dallas, Seattle, LA, and Miami. So there you go. This is one of those things that I think it's very cool for you to think about and consider, and you likely have already. And you can do this whether you're buying a personal residence, whether you're buying an investment property, because when you buy something that has some sort of apartment or whatever, then you potentially have like 2 units that you can rent as opposed to one. I know many people that have gone out there and have purchased, right, like their individual home that they live in, and then they rent that apartment that is somewhere in the back of the property. But I've also known some more astute individuals who have moved into that back apartment and rented the main house, so that they can make more money, make more payments and stuff, so that they can expand their portfolio. They were willing to short term make themselves a bit less comfortable for long term financial gain. You can do the same thing, but you don't have to, right? It's just an idea, just an idea, just an idea. All right, and final piece that I wanted to share here with you before we part for the day is what's going on with the jumbo mortgage debacle. And there is a big potential challenge coming in, and this is coming out of Market Watch if you want to read more about it. Jumbo mortgages are loans that are larger than the limit set for Fannie Mae and Freddie Mac. See, Fannie and Freddie became Franny in my world, or the FHA guarantee to insure. And so what is going on is that there is some potential challenges with this piece. Starting in 2016, jumbo mortgage lenders have tripped over each other to hand out huge loans to applicants. Between 2016 and 2019, roughly 1.5 trillion, sorry, 1.5 trillion of these jumbos were originated. Interest rates and underwriting standards for jumbos were actually lower than for conventional loans. Can you imagine that? Of course you can, because why wouldn't you? If they can make more money and somebody comes with higher credit and they flash a little bit higher paying job, yes, that is the unfortunate situation where we find ourselves. And now here's the table of kind of what's going on in the 25 largest U.S. metros, and kind of what's been happening. And you can see the purchases and refinance, and this is, of course, the jumbo only. I love it when they do the table. It's so much more helpful when they do the graph, because, and I wish that people that like put this stuff out there would understand it. And, had I thought about this sooner, I would have created a graph for you, but I didn't. My apologies about that. Uh, but you can see that, we went from super high, kind of shrunk down. We started to sort of increase, kind of. Of course, we're down now in 2020, at least first quarter, right? So, but then again, we'll see kind of how that worked out. Uh, 46% of borrowers who obtained a forbearance actually made a mortgage payment in April. However, that percentage has plunged over the past 2 months. According to Black Knight, 22% of borrowers had paid their mortgage in May, and only 15% did so in June. The mountain problem of wealthier homeowners with jumbo mortgages, they have also been slammed by the lockdowns. 11.8% of all jumbo loans were in forbearance as of June 16, more than double the rate as recently as April. 42% of their customers who requested a forbearance were self-employed, uh, which makes perfect sense, right? But they might not be employed anymore. And the CARES Act didn't say anything about the jumbo loans, so that means that many jumbo loans and forbearance and stuff may or may not be happening. Most lenders sharply cut back or even stopped offering cash out refinancing, and interest rates quickly climbed above those for conventional loans. So where there was lower, now they're actually running higher. And we talked about it yesterday, so you can go and take a look at the rates. Many homeowners with jumbo mortgages are owners of small businesses which have been devastated by the lockdowns, and many of them might not qualify for the PPP loans or any other loans or grants or any of that stuff. So they're struggling big time. Most of the residential mortgage loans held by large banks are jumbo mortgages, and unlike smaller loans, which are actually sold on second and tertiary markets and they're securitized, jumbo loans are too big to be guaranteed by anybody, and so they sit on banks' balance sheets. 95% of jumbo loans remain on the balance sheets of the banks. And this is one of those things that is interesting. While it impacts obviously the homeowners and the small businesses, right? It also impacts the banks because they're holding on to these like largest pieces of stuff that people have hard time paying. In the mid 2019 FDIC call report showed a redefault rate of more than 40% for their modified loans, also known as TDRs, troubled debt restructuring. Study by Fitch Ratings shows that 75% of Fannie Mae modifications that redefaulted had done so within 2 months of remodification. Now, the interesting piece about the article is that they never really conclude stuff. It's just this sort of like a rant and throw in a bunch of different information, and you leave like scratching your head like, what does that even mean? I don't understand what that means. What I think they're trying to drive home is that they're saying that there is a high redefault rates, and it happens within 2 years of modification. So many of these jumbo loans are going through remodification and restructuring and that kind of stuff because they cannot go into forbearance. So they're likely going to some sort of remodification. Hopefully they can do that. What I think the article is trying to drive home the point, but they're not. So they're not concluding it for you, which is why you're watching Money Matters, because we do that. We kind of connect the dots. And if we don't, you can always ask a question. And of course, I will answer. So what it's basically saying is that about 40%, so almost half of them, when they have to remodify the loans, they default, and they default within 2 years. So remodification is happening right now. So what they're saying is by around summer of 2022, we could see a sharp sort of flop in the jumbo mortgage market, meaning the largest homes may go up for sale in summer, fall, so spring, summer, fall of 2020. There was also some additional reports that I didn't pull up over here, and I don't have, that are indicating that there are some projections coming in that are basically saying that we could see prices tumble of real estate in late 2020, early to mid 2021. So winter, spring, summer, and of course it makes sense for all the reasons that we have talked about, which is the whole forbearance is expiring this fall into winter, which makes sense why, we would see a little bit of a dump, and of course into the spring of 2021. So buyer's market is coming, but it's not here yet. It is a hot seller's market, and one way that it does make sense is through utilizing value investing properties, which you can learn way more about looking at onedealaway.com. You can consider Academy, or you can look at things like Flip It Online Masterclass or Real Estate on the Cheap Challenge. So there you go. Thank you for watching. I hope you have learned something, and we'll see you tomorrow. Until then, stay forever money blessed, and do remember, you are only one deal away